My guest today is Corey Rosenblum, and we're talking about integrating two time frames into your decision making with your trading. So Corey, why two time frames? Why is it important to look at the two different ones for making decisions?
Sure. Just traders look at one time frame, so the daily chart only, are going to miss the salient details or more information that can be gleaned from the lower frames, even something as simple as an hourly chart or a 30-minute chart of, say, a swing trader. A lot of times lower time frames can be used to time entries better. For example, if the daily chart shows a support level, say at $100 for example, and the stock is moving down toward that, and it's in an uptrend, a trader wishes to put on a swing trading position. Well, one can either just wait for the market to come to that exact price, or they can turn to a lower time frame, 30-minute, maybe a 15-minute, and see what's happening. Maybe there are positive divergences. Maybe there are volume bars that are picking up. Maybe there's any other kind of indicators, overbought stochastics, or whatever the indicators that they are using in their strategies may be adding buy signals into the higher time frame level.
All right, you talk about positive divergences. What do you mean by that?
Right. A positive divergence, say in momentum, is looking at when momentum makes a new low and price makes a new low, that is a sign of confirmation. We would say when price and momentum make a low together, that should lead to further price lows to come. But a non-confirmation occurs when price makes a new low, especially in a pronounced or a longer term downtrend that one's been going on for quite some time. And then the momentum oscillator, or whatever the indicator they're using, or market internals, if it's the S&P or the Dow or etc.
Like a MACD, that would be.
Yes, a MACD, exactly. There's an indicator called momentum, RSI, even stochastics make divergences, or rate of change. Anything like that can be called a momentum oscillator for confirmation, non-confirmation. If that indicator makes a higher low relative to its prior low, that is a divergence. And it's a sign of non-confirmation. That trend, especially a longer term or a mature trend, may be coming to an end, and a reversal may be near.
All right, so in some sense that could be a leading indicator for you. You've got higher momentum, but a lower price. You'd expect the price to turn around at some point.
Especially into a higher time frame support level. Absolutely. Could be even a complex level, Fibonacci, a trend line, or simply a price level. Round numbers work as well. So it's just another way to integrate additional information and timing signals into higher frames.
All right, so what has more weight? Is it, if you're trading an hourly and a 15-minute, or say a daily and an hourly, is the higher time frame, the signals you see there, do you give them more weight than the shorter time frame?
Absolutely, especially looking at the weekly chart is going to be higher, or the monthly even for that matter too. A lot of swing traders don't take decisions or take signals off monthly charts. Few do off of weekly, but most focus on the daily. And so the higher frames will dictate. That's the supply-demand imbalance. A trend, simply stated, is an imbalance in supply and demand that occurs over time. So if there's a higher time frame trend, a higher time frame support level, on a weekly chart, more traders, more funds, more participants are going to take action at that level, putting on new positions, taking off old positions, or in the event that that support level breaks or fails to hold, we'll be initiating new positions, say shorts. So those will bring in more traders of higher time frames. Lower time frame traders tend to be more active, but there's the current that takes place in the higher frame almost overrules that. So for me, it's looking at signals, clarity, and what other kind of signals from the lower frames into higher frame levels. And it gets a more confluence of the indicators.
So if you've got something on a daily time frame that's at support and on an hourly time frame that's at support, that's ideal.
Especially if it's a Fibonacci on an hourly chart and also a higher time frame support level, the more factors we can put in our favor in putting on trades with the tighter stops tends to be better. It doesn't guarantee a successful outcome, but it gives us more clarity and more confidence to put the trade on.
Corey, thanks for your time.
Thank you, Tim.
You're watching the MoneyShow.com video network.